everyone. Apologies for a small delay that had happened because of the team. Probably they might be discussing today's Russian invasion into Ukraine and its impact on the market. So having said that, I think this panel is looking at a long-term implications of sustainable finance. Thank you to the distinguished audience over here, and thank you to the distinguished panel, and a very good morning to you. So when Dr. Dipali had requested me to anchor this session, actually, so and with the instruction that you should speak only 4 lines about the panelists, actually. She had given me a 3-page document, which is the profile of all the speakers, actually. So it was a big task in terms of shrinking them into 1.5 page, and then doing my own research, knowing about each of the panelists, and which I wanted to highlight it to the researchers who have gathered over here, so that they can understand and put in their questions from the perspective of the background from which each of the distinguished panelists are coming from, actually. So I just wanted to indicate to all the researchers who have gathered over here that it is a unique initiative by the organizers of NISM SEBI Research Conference to connect industry leaders with researchers in an effort to align research needs with problems in finance that needs independent analysis and rigorous research-based output. Interestingly, this session follows a panel of interesting research papers in sustainable finance that have been accepted for presentation at this conference. So probably they would have some questions from the panelists who have gathered here with their own perspective about different aspects around sustainable finance. So to introduce sustainable finance to those researchers who are not much familiarized into this aspect, is all about making investment decisions in the financial sector, taking due account of environmental, social, and governance consideration. So what has started as a movement to get the businesses to be conscious of its social impact, and the corporate governance has slowly expanded to include the environmental impact of businesses as climate change as a science carved its own niche and developed the understanding among the humanity. Having said that, finance is finance, and it always seeks to outwit the benchmarks, if not in the short term, but in the long term. So while sustainable finance emerged to carve out its own niche in itself, the performance of sustainable finance or activities around sustainable finance have always been compared with the same metrics as like any other finance or investment themes, contrary to the example the corporate social responsibility, which is an expense-based measure that stood for the larger economic goal. Likewise, the CSR and donations invited proposals that had larger public impact, and sustainable finance always followed the measurable return to investment. So far, the growth of sustainable finance as a cult has primarily been driven by increasing awareness and appetite, followed by national mandates in nations such as European Union. And so that's why we have experts from UK, South Africa, and New Zealand, and coming and sharing their experiences around reporting and accounting norms and things like that, actually. So that has sculpted its own path to achieve the common goal of reversing climate change apart from sustainability and governance in the listed businesses, including the unlisted businesses. The growth of sustainable finance will largely be driven by the independent research studies that would potentially guide investors in coming days, because the growth is dependent upon the demand that is coming from, because the returns to sustainable finance will always be challenged in the short term amongst the investors who are actually chasing the short-term returns rather than the long-term returns. Keeping in mind, this session has been organized to discuss multifarious areas such as reporting, qualitative and quantitative measures, and its relevance to investors and accounting methods for such investments. So I mentioned that it is a unique initiative at the beginning to indicate that it will be for you as financial market researchers to engage fruitfully with the industry experts who have been working with businesses and investors to carve out a niche path to develop this future path of investing. This will not only provide future direction to your research in sustainable finance, but it will also be an opportunity to know about various national and international efforts. The panel of experts include practitioners, experts with experience in setting national and local standard setting bodies and setting up reporting standards. So coming to the panel will be chaired by none other than Mr. Cyril Shroff, who is managing partner at Cyril Amarchand Mangaldas. So for us, in the markets, he doesn't need any introduction. But for the researchers, let me have a quick introduction about Mr. Cyril Shroff. He has over 40 years of experience in a range of areas, including corporate and securities law, banking, bankruptcy, infrastructure, and financial regulatory as an expert practitioner. Mr. Shroff has been a part of various regulatory committees and national committees and councils in various areas spanning from corporate governance to capital markets. Apart from various recognitions such as the M&A King of India, he was recently being recognized by Who's Who Legal 2022, which has recognized him as thought leader, global elite for M&A and governance. He is also a board member of PIA University and a member of the Apex Advisory Board of Adani Institute of Infrastructure Management, and also the advisory board of Center for Study of Legal Profession established by the Harvard Law School. And he has completed his BA and LLB from the Government Law College in 1982. And we are indeed privileged to have you, sir, to lead the discussion. And to introduce the panel, let me start with Mr. Ajit Dayal, who had in his experience spanning over 30 years, had not only founded initiatives such as equitymaster.com, personalfn.com. So these are initiatives which he had done to connect the retail investors with the market and to enhance the understanding of the markets to them and to provide them with as much financial information as possible. On the other hand, he also had been a founder of a unique initiative which is called, which many of us may not be aware, National Streets for Performing Arts. If you are interested, please visit the website, which is www.nspa.in. And this website supports busking in Mumbai with simple but revolutionary idea of paying musicians a salary with not hat or guitar box, seeking donations from the audience actually. So it's currently supporting about 90 artists with an average performance of 250 hours in a month, spanning 3 art forms, which includes theater and poetry along with music in over 24 venues. Currently, I understand that it's operational only in Mumbai and Goa. So hopefully, Mr. Ajit, I think it should expand over a period of time and to cover more cities and more audience as well. So coming to the financial market side, it is notable that he has founded Quantum Advisors in 1990, besides his work experience with Ansberger Global Investors and Vanguard. He has a master's in business administration from the University of North Carolina at Chapel Hill after his economics bachelor's from Bombay University. We welcome you, Mr. Ajit, and look forward to hearing your views about future of ESG investing and the role reporting will play, because you are the pioneers and actually putting this ESG screen before anybody else from the asset management perspective. So we also have with us another authority, who is a global authority in reporting, Mr. Conor, Kehoe. Mr. Kehoe, I'm sorry if I'm mispronouncing your name. Am I right? Kehoe. Okay. Who chairs the International Integrated Reporting Council. So I did a little bit of research to know what it is, and I thought it might be relevant for you also to put it together. So IIRC, which is the International Integrated Reporting Council, is an international coalition of 70 organizations cutting across regulators, companies, standard setters, accounting bodies, and NGOs. It's an interesting initiative that has the remit of developing globally accepted international integrated reporting framework that elicits from organizations material information about their strategy, governance, performance, and prospects in a clear, concise, and comparable format, which makes investment easy for the investors, or making investment decisions easy for the investor. Apart from being a member of G7 Impact Task Force, he is a board member of Value Reporting Foundation, an initiative driving global alignment of corporate reporting systems, and BlackRock as an advisory board member. So coming back to the background, it was again another interesting thing that what I found out at McKinsey and company of UK. He is founded and co-leading the Board Intelligence Forum for chairs and non-executive directors. From his background, he's a software engineer by training, and Mr. Kehoe also led McKinsey's tech and telecom practice in Europe. That is from the business aspects of what he has been practicing. From a social aspect, it is notable from his profile that he is a continuous learner aspiring to contribute to the development of IT skills amongst the developing countries besides its ESG reporting initiative. Thank you, Mr. Kehoe, for your kind acceptance to be part of this August panel. And I'm sure we will be enlightened with your experience working with various regulators and entities in moving the integrated reporting framework further forward. So we also have with us another distinguished speaker from abroad, Ms. Joanne Henstock, who as an executive director with the Princess Accounting for Sustainability project. That's again another project which is more about accounting for sustainability. The project, in collaboration with the accounting bodies network, has provided an open cross-border platform to share knowledge and skills around sustainable finance, overcome barriers, and champion the change within the accounting community. She carried with her an established career in consultancy, spanning across ESG and sustainability disciplines with a large global accountancy firm. Our core experience has been into ESG reporting and related assurance processes designed to support investment markets. Ms. Joanne is a chartered accountant in New Zealand and South Africa and holds a membership of the Institute of Directors in both Australia and New Zealand. We welcome you, Ms. Joanne, to this panel, and we look forward to hearing your perspective from an accounting side of accounting for ESG investing. Lastly, let me introduce industry leader, Mr. Mukundan, who is the MD and CEO of Tata Chemicals Limited. He's an elite member of Tata Administrative Service with an MBA from Faculty of Management Studies in Delhi University. So he's a distinguished alumnus of IIT Roorkee, fellow of Indian Chemical Society, and an alumnus of Harvard Business School. During his 30-year career with the Tata Group, he has held various responsibilities across chemical, automotive, and hospitality sector within Tata Group. So Mr. Mukundan also serves on various industry forums and impact organizations. Let me welcome Mr. Mukundan on your behalf to join the panel discussion, and we look forward to learn from your thoughts, Mr. Mukundan, from an industry perspective, what is going to be there. Ladies and gentlemen, with this introduction, I've slightly exceeded my mandate, but let me welcome Mr. Shroff to take the session forward. Before Mr. Shroff takes over, a few housekeeping requests. The session is likely to finish by 12:15. So maybe we will give you 10 minutes of time for Q&A, depending on the speaker that you would want to address. So we would request you to identify yourselves and keep your questions short, straightforward, and simple, addressed to the particular participants. Those online shall post it on the chat box, which I can take it up with the panelists and for the participants in the hall. So the mic is yours, Mr. Shroff. We request you to take the discussion forward. Thank you. Hopefully you will complete the discussion by 12:05. Thank you.
Thank you. Thank you so much for setting the stage for this conversation and for the generous introductions. We are a bit crunched for time, but we have about 35 minutes for the discussion and then 10 minutes for Q&A. So I will keep my initial comments also very brief, and then dive right into the panel discussion. So as we all know, there is a unprecedented focus on ESG. It is a significant upgrade from the pure governance conversation that ruled the roost for a while. And we are seeing a much broader, not only a broader discourse, but also a broader partnership emerging between various stakeholders, including providers of equity finance, whether it's the public markets, private equity, sort of rating agencies, commentators on the sustainability agenda, debt providers, and the broader kind of economic community. So this focus, I think, is clearly helping in sharpening the debate and setting goals for business across the world to achieve the global targets. But as we all know, money is a very important part of the entire journey. Money as in finance. And consequently, this conversation today is most apposite in terms of what is going to be the role of sustainable finance. And we've seen tremendous strides being made both globally as well as in India. So I'm going to first start with Conor in getting his thoughts on some of the aspects relating to the debt markets and bond markets, especially because we all of us know that this transition globally as well as specifically for India is going to require a lot of money. And only some of it is going to come from the equity markets. The expectation that for net zero for India by 2070 is a $10 trillion investment that is going to be required. And clearly bond markets and other forms of debt finance are going to be a critical part of it. So Conor, we'd love to get your thoughts in terms of, firstly, is this achievable? Is this even possible? And also to get your thoughts on the opportunities and challenges, and how do you expect the bond markets to react to this? So over to you, Conor.
Well, thank you, Cyril. And Cyril, you put me in a situation that breaks an important rule, which is never make predictions, especially about the future. So here I am looking out 50 years. Is 10 trillion feasible? Well, it's about 200 billion a year. The Indian economy is 15 times larger than that. Could the Indian economy find 7% of itself to invest in green energy over the period? It sounds to me like a sort of feasible number with the right incentives in place. So if you want a prediction, I think it could be done. But of course, the incentives have to be in place. And here I would say the main danger in these incentives is not so much getting the money in, it's starving, polluting industries of money. And we've seen in Europe, the minute gas or petrol prices go up, we have protests in the streets. You may remember the Gilets jaunes in France. So this has impressed upon me the need for politicians to manage the transition carefully, because it can impose a lot of costs on poorer people. So the finance may be available, the incentives to induce the finance may be available, but it actually may hit the household budgets of some of the poorest, and that can lead to social unrest. So managing that transition, those transition incentives will be a delicate government task, but I think it can be done. Cyril, you're on mute. You're asking a follow-up question, but I can't hear you.
Yeah. Any advice to our policymakers and environment in terms of how they should be balancing the incentives and challenges in the journey ahead? Because there are many of them who are listening to this.
My 2 cents worth on it is I think actually the Europeans have done something reasonably wise by using as politicians staying somewhat behind the scenes. So they're using financial stability in banks as the means of executing climate change finance. And you might think that's a bit sneaky. They should be, as politicians, out there leading rather than leaving to the bankers. But I do think that there's a case to be made for the finance community being in the lead with the politicians there to rescue them if things go wrong, as against having the state front and center. And when things go wrong, they're the ones who have to take on the burden. So at least that's how they've decided to go in Europe. So you'll see the finance industry is in effect the chosen policy tool. And I don't think it's a bad thing. I think it protects the state.
No, I agree with that. Before I go to the second topic relating to the equity markets, I'd love to get some thoughts from the other panelists on your observations and anything that they would like to supplement on bond markets or debt markets in general. So Joanne, Ajit, Mukundan.
Cyril, I think I'm not going to go into debt markets and other markets, but since you asked the question on policymakers, I think we need to address three broad issues in terms of the broken system in India in energy transition. One is the state electricity board issue. It's not related to financial markets, but these have got to get done. Otherwise, the whole point which Conor raised with respect to people protesting will be a big issue. In addition to that, I think we need to have some energy policy in place, whether it's, how we're going to deal with natural gas and all these various alternates to coal. And lastly, I think we've done a good job in solar and wind, but I always say that on nuclear, we are stuck a bit because of the liability issue. Someone needs to address the liability issue at the policy level. This is not meant for finance people, but this is the policy points.
Absolutely, because it's a broader aspect of the energy transition. And unless all these pieces are moving in tandem, we won't get there. So thanks for that insight, Mukundan. Joanne and Ajit, any thoughts before I move to the next topic?
Yeah, I think I'll just get myself off mute there. Oh, I am off mute. Apologies. Yeah, I do think that all of these markets. I'll speak to the point later, but these markets all require to work effectively and to actually take off. You might say, require effective engagement from all parties involved in the market. I kind of heard that point in the last speaker's remarks as well. Effective engagement from all parties involved in these markets is critical for them to work. And when there's failure there, you're going to get some dysfunctionality happening.
And I'll just sort of add one last point is that at some point in time, India has to become part of the global bond indices. India is not part of global bond indices now. So if you're a passive investor investing in a global bond index, whether it's a regular bond index or an ESG bond index, India is not in it. You won't get the allocation. So that's another thing that India is working towards.
Very
and I'm sure in the next few years, we'll get there.
Thanks, Ajit. Let me shift gear to the second theme on equity markets, and this theme is also evolving around various fronts. A significant part of this conversation has been driven by the index funds and particularly the likes of BlackRock and their iconic chairman Larry Fink, who has been driving this agenda as well. But of course, it's a much broader conversation. We are not only seeing index funds sort of be very focused on this, but also private equity funds, specialized funds. And so it's now really spreading its wing across the entire equity space. Let me come to a related issue of equity markets and disclosures, because one of the tools that policymakers use for making sure that equity markets and investors are conscious of this and that companies are held accountable is to constantly keep ratcheting up the disclosure standards. And this is one of the sharper tools that policymakers across the world have in their toolkit vis-a-vis the equity markets, and India has caught up on that. So whilst this journey has been there going on even from more than a decade ago with voluntary standards, and then the Ministry of Corporate Affairs led BRR regime, we are now at a very different stage where we are on the threshold of a broader sustainability reporting regime by the name of BRSR, which is going to be applicable to the top 1,000 companies by market capitalization from the 1st of April for financial year 23. So I'd love to get your thoughts, Ajit, and then the rest of the panel on the evolution of disclosure standards what role does it play in the operations of the equity markets, and where do you see this going forward? And after your thoughts, Ajit, I'd like to get the observations from the others.
Sure, great. I have a lot of thoughts. I'll begin with a bunch of them, I guess. As we've alluded to, it's very important that India gets sort of its sustainable, at least on the climate side, right, if you want planet Earth to survive the way we can inhabit it in that sense. And unless we have a course correction, and a significant course correction, India will account for about 30% of global greenhouse gas emissions by the year 2035, when the global target is meant to be about 55, 60 billion tons per annum. And if that happens, if India is going to be emitting 18 to 20 billion tons by 2035, if we keep on the continuous course we're on, the path we're on, we'll be basically toast. Again, from a broader investment perspective, keeping aside the money required for climate change, we have to recognize that India is the largest untapped economy with a huge potential for profits for long-term surplus owners. So if you're a pension in the developed world and you're looking for long-term returns, China has given you returns for previous decades, and so has India. And India still has a couple of more decades to go compared to China, because we have a much younger population. And we could be getting over $100 billion of new financial capital every year for the next 20 years. And I'll put this number in perspective. Since 1992, when we began with the FII rules, we've received about $220 billion. So since 1992, we've got 220 billion, and the market value of that today is about 1 trillion roughly, but you can get 100 billion a year. So that'll of course be significant amount of capital for Indian companies as they wish to grow and meet demand globally and offshore if they wish to export. And many of these owners of global capital are increasingly focused on ESG criteria. So they're looking at their global companies, what's happening on ESG, and now they're looking at their Indian holdings on what's going on in ESG. Luckily, and to the credit of the Indian regulator SEBI, SEBI has been extremely proactive, very alert, and is leading from the front. So you've got a whole bunch of rules, what you just spoke about, the business reporting standards that are coming out. But there is a perception amongst Indian companies and Indian investors that, can we afford to get ESG? Do we have to focus on ESG? Should we first be rich and then should we focus on ESG? It's a luxury of the rich. And that's a false argument. I mean, if you take a person who's poor and they eat unhealthy food, they're not going to live very long. In a very similar way, if you have an economy that's not healthy and you face, I'll get rich before I get healthy, you won't be surviving as an economy. You'll have a lot of problems in your society, et cetera, et cetera. So we are on that move towards course correcting, if you will, to focus on the 3 Ps, which is planet, people, and profit, as opposed to profit, profit, profit. So that's clearly the change. And I think that when you look at the rules that are coming out from SEBI, and when you look at the practice of Indian companies, again, nascent, I think it's a good direction. There's clearly a lot of companies embracing it. And there are some companies that are what we call EHG. They are following a path of eyewash, hogwash, and greenwash. So they have annual reports, they make statements that say things, but when you actually pinch and you try to see what's happening, they really fall short. So one of the things that I'm sure Joanne will talk about this soon is that we don't have proper standards yet. So going back a bit in history, in 1996, Quantum started something called the integrity screen, which was a way to really measure, to assess G, the actual governance in a company, and somewhat of the S, but we didn't really pay much attention to the E. So that was 26 years ago. By the year 2011, we began to hear that there's something called ESG in the world, people are following it, and we converted that integrity screen to a full-fledged proprietary ESG database, which we built on our own. And the reason we built it on our own is because when we spoke to global scorers of ESG, we found that companies that we thought were terrible were ranking very high with them. So there is no one standard as yet, and it will come. And when it happens, that will be great. So we're all evolving, we're all learning. And I think there is, long way to go, but I'm really optimistic about it. And I'll just give you two reasons why I'm optimistic. In 1988, 89, when we came out with the first stock market yearbook, giving a collection of data financials of listed Indian companies, we were not able to get annual reports of companies unless you were a shareholder. So we used to go to the Radiwala, to the guy who had excess papers and newspapers, and buy by the kilo, old annual reports from them, and then sort of put in the data. Now, of course, information is freely available to anyone who wants it, whether you're a shareholder or not. And the other thing that I'd like to focus on really is that companies themselves, particularly factories in townships, they ran the entire township. I mean, if you went to Renukut to see Hindalco, Jamshedpur, Tata Steel, IPCL, Baroda, they ran the whole township. They made sure the staff lived in good quarters. They had movie theaters. The kids had schools. They had hospitals. They had playgrounds. So there was a lot of focus on S, if you will, at that point in time. And then I guess people like me who did joint venture with international firms brought to India this focus on quarterly profits, and everyone began cutting costs and becoming more efficient. And the easy way to cut costs was to give, as always is the case, the lower people less money, and the CEOs get more money. So I guess we can be partly blamed for that. But there was a culture, a strong culture amongst Indian companies to take care of their staff. And I'm sure it's going to come back again. So we've just started. And I think that the sort of templates are right. There's still much to be done, but I'm really optimistic about the future.
Thank you so much for those insights, Ajit. And I'm going to come back to a couple of points that you made, but not before I bring in Joanne and Conor into the conversation.
Cyril, I'll go first. I thought Ajit's comments were completely on point. I think that what he's really saying is pointing to the fact that this idea that capital should produce outcomes that are inclusive, that involve wider stakeholders, is absolutely critical. One tends to find that in emerging economies, this is more starkly played out than in developing economies. It's true. His comments on the importance of the S and the E, as well as the E, are also well taken. In fact, in developing economies, we see so much attention focused onto the E, the environmental matters and climate matters. And indeed, these socially important human capital matters are also very important. So, yeah.
Conor?
Well, if I sort of step back from the corporations I still talk to from McKinsey and Company, ESG disclosure is very powerful for two reasons. One is investors act on it. And so corporations hear from investors that they want improvement in performance if corporations to get access to capital. And secondly, millennials and Gen Z act on it. And you soon find that you can't employ younger people if you're not performing well on this dimension. And furthermore, they won't buy your products either. And so that becomes investor material very quickly. In an odd way, the pressure comes from above from investors, and if you like, below from the younger age groups. And my generation can sometimes be a bit flat-footed because we were brought up on Milton Friedman's philosophy of the social purpose of companies being to maximize shareholder value. Well, I can tell you there's a generational shift. The desired social purpose for Gen Z and millennials is to do quite a bit more than that. And companies are finding this out, and boards and management are following the people they were supposed to lead. And it's a slightly uncomfortable journey for them. To the specifics of reporting, ESG reporting is tricky. The biggest challenge with it is not just getting the data from within the company, which is hard enough, it's new data, but actually reaching back into the supply chain and getting data from there. That is pretty tough. It's not that easy to do. Some of the more powerful outputs come about when people actually look into the future. So a lot of what's reported now is obviously historical numbers, but TCFD is a stress test where you project what your economics will be under different future climate scenarios, like 1.5 degrees, 2 degrees. That's proving to be an eye-opener, although it's a very stressful test for directors, especially American directors, who think I get sued for historical numbers. Imagine how I'm going to get sued for numbers about the future. But it does provide insight. And it also justifies investor involvement, because if the numbers change, the future numbers change because of different climate outcomes, then climate becomes legally relevant for them. And they always worry about this. A second Trump administration might try and squeeze them out from considering it, but TCFD gives them the ammunition to consider it. And then the final thing that's on the way for those who are interested is there is a movement that I'm part of to try and take all of these ESG indicators and monetize them, put dollar values on them. And the way that works is Harvard has been doing some of it, and they point out that wonderful yogurt company, Danone, whose profits, I believe, are 3 billion a year, EBITDA, the cost to society of the sugar in their product is about 3 billion a year. Conversely, General Mills, that makes fiber-based foods, Weetabix is its famous product, they're about a 2 billion a year EBITDA company, and there's a 2 billion net positive health effect from selling from their fibrous food. So I think as we start to take these ESG indicators and turn them into dollarized or euroized or rupeeized amounts, it'll add a whole new insight into the social positives and negatives that are being produced by companies. Already it's quite powerful. I think it's only getting more powerful.
It's very interesting because financial markets really have a sort of a very purifying way of looking at some of these things. So that's a great insight. And just to give a little Indian context, so India has been quite front-footed on this, and not just the recent SEBI changes that are coming through, but it's almost since the New Companies Act of 2013 and a little before that, philosophically India had moved to the model of stakeholder governance. So we had kind of rejected the Milton Friedman doctrine a long time ago, and are actually one of the few countries in the world which have enshrined it in our corporate law as the basis on which companies should be governed. Now, there are open issues in terms of how this is going to be enforced or justiciable, but that's another problem. I think at least the fact that the conceptual basis of the corporation is not just for the purpose of making profit, but it is linked to the whole idea of a license to operate for the benefit of all stakeholders and society as a whole. So these are baby steps, but very important baby steps that have been taken at a very foundational level by India. And I think now with these disclosures and other pieces of the jigsaw puzzle falling in place, that India is going to move very rapidly on this. And we are seeing a lot of changes even on the financial side, with our central bank giving a lot of impetus to ESG themes more broadly, including climate. Let me now move on to the third theme, and I'm going to call upon Mukundan to talk about it. Essentially to give us a viewpoint from a corporate India perspective. And Mukundan, apart from kind of representing corporate India in general on today's panel, is also personally very deeply interested in governance and the ESG theme. So Mukundan, can you kind of share with us, what is the level of enthusiasm in corporate India, and how are they grappling with the fact that this is going to require a lot of money and effort to pivot into this new paradigm of sustainable growth, and actually to start making investments before demand in a way, and to help kind of bridge a lot of the short-term transitional challenges, including societal challenges where ESG and environmental consciousness could be seen as a luxury rather than as a very relevant theme in the short term for a developing economy. So how is corporate India grappling with all of this, and what are your insights and expectations from the financial markets in partnering with corporate India in achieving this?
So,
over to you.
Yeah, so, Cyril, I think what we do find is a whole range of reactions to this, and I think starting with the people who are already well on the journey, who are committed to this, who are convinced of the change, and who believe in basic ethos that an organization, if it has survived, like Conor said, or Ajit said, or Joanne said, you need to build trust with your stakeholders. I think that starts with the cornerstone. And if you take that as a fundamental principle, there are many companies which are moved on the journey because they do believe in the long run, the only organizations which will survive are the ones which have purpose, sense of purpose, and have deep inroads into their own organization culture with building value system which are embracing all these points which you mentioned. I mean, there are many dimensions to this. I want to just say that only day before yesterday, I took up a conversation with Finance Minister about adding social sustainability. In addition to that, the digital transformation. I also said, what about inclusion and diversity? I mean, if that room was full of men and only she was the lady in the room. So I asked her, and I think it led to a whole host of conversation. And most people who were in the room were all people who were already on the journey well. The issue which you raise about which are the pieces which are finding it difficult, I think there's a large mid-sized and small-sized companies in India. MSME sector is large. I think we need to sort of always think about them. They may be unlisted, but the fact of the matter is giving them the support and guidance to make the transition is very critical. But broadly speaking, I think the capital markets have already started to reward those who exactly to answer Ajit's point, if the only way you can build trust is by reducing the say-do gap. What you say and what you do must be in sync. And I think the companies which have reduced the say-do gap are having a premium in the multiples, in their earning multiples, and they can see the valuation. So it's clearly getting reflected there. Secondly, I think many of us in corporate sector do believe that transparency is not equal to disclosure. While government is forcing, and this goes back to what I grew up, in my group, many of you would know Ishaq Hussain was our finance director. He used to tell us constantly, we need to look at niyat, not at niti. So, and I think in India, niyat means, the behavior, not at the law. Law only is a final recourse, but I think firstly we have to change our behaviors. And his whole point was that if you have to change behavior to build culture and value system, I think that's a broader agenda here. And I think corporate sector has taken upon itself. Organizations like the industry associations are working very hard to sort of push this agenda down. But there's a large swathe of difference in terms of the way people are embracing it. And I think that goes back to what Ajit said. There's a whole set of companies which may be just using this as a whitewash or whatever. But I think those who are serious, I think the large companies have embraced it fully. There is a middle which wants to change, but I think which needs help. And the MSMEs certainly need help, not just from us, but also from the government and policymakers. And these things would be in terms of, how do you help them to make first few steps? And I don't think penalizing is the way to get this transition underway. You have to make it very positive change in terms of saying that this journey is going, you're going to get incentives and positive incentives on the. So in procurement policy of government, we can certainly make a lot of impact. In the procurement policy of companies, large companies, they can make an impact when it comes to this large chain, which we are talking about. Also in hiring, in terms of our training programs, there are a whole host of stuff which we can do, which is not on the financial markets. Financial markets only reward the final outcome. But I think it's a lot of work to be done internally. It's specific to operations of company as you see it as a whole organization.
And just to add to those list of topics, Mukundan, I think in privatization also. So, of course, the Tata Group just completed the acquisition of Air India, but there is a whole mountain of other opportunities for either asset monetization or privatization. And one of the criteria which the government should follow should not be merely who's the one who's going to sort of give the most value, but who is going to be the most ESG compliant in the future as well. Otherwise, you could have a set of buyers who would take over these massive assets and run them to the ground from a sustainability point of view. So one of the factors, a qualitative one, which should enter into the journey. And I've said this publicly as well, is not just the financial value of these offers, but also the ESG score. And I think it will be transformational, because a lot of these assets are so critical for our society and environment. Let me now come to the fourth and last theme before we go for Q&A. And I want to come back to standards and to bring in Joanne into the discussion. So just to recap, India is about to tip over into a mandatory sustainability reporting regime. It has assembled this standard after a lot of comparative study across the world, including TCFD, SASP, and all of these have been sort of factored in. But my question to you, Joanne, is finally when these standards get implemented, and you've seen that in across markets, is what is the mindset change that is required? Otherwise, we will just have compliance, we will have tick the box. There are even a number of service providers who are already thinking about this as a commodity and probably writing algorithms for getting this complied, which rather than in order to bring the cost down and make this into a $10,000 product for companies, instead of getting to the soul of why this is being brought in for really improving transparency, or to borrow from Mukundan, the niti rather than sort of go into the philosophy of why this is coming in. So how should we be thinking about it from a mindset point of view? And what are a few tips and guidances from you to the audience, in which includes several members of corporate India, on how should they embrace this new disclosure regime?
Thank you, Cyril, and I acknowledge also the points already made by Ajit and Mukundan and Conor touching on the subject. I think the key thing to note here is that this is about quality of material information to the investment markets to inform them on corporate performance. It is, of course, critical and for effective and efficient working of investment markets. In fact, it's the lifeblood. Investors also really value the ability to access the board and executive management to seek further information as needed and resolve any information gaps on key matters. So the introduction of the BRSR is now part of your reporting environment in India. And the comments that I'll make next are sort of positioning that important event in India against what's happening globally and internationally. And of course, we know that the key thing that everyone's waiting for this year in the reporting market is the standards that will be introduced by the ISSB and will be published and done and dusted as final standards during this year, 2022. So the key question is whether investment markets will indeed be satisfied with the results of implementation of these standards when they land. I think this point perhaps escapes many. Everyone's waiting for the standards, but as you say, Cyril, what the market is not waiting for is a mere implementation of these standards in a compliance type mindset. Very important is to position implementation of the standards in an investment market mindset, which is all about making sure that those the information disclosures that land in the market as a result of application of those standards will indeed be fit for purpose and will inform markets sufficiently of these important ESG type matters. So this is still a matter to be seen. It'll very much hinge on each corporate reporter's attitude to ensuring that the investment market and its wider stakeholders are served regularly with high quality information disclosures. And this is, of course, to keep investors and other stakeholders informed about the company's business, its business model, and key aspects of its performance against adopted strategy. So looking at this then, it is the board and the governing body of any reporter that needs to exercise strong oversight governance of the baseline settings that the company has in place for its information disclosure practices, and ensure that those meet the investment market expectations as far as practically possible. Also, that these settings give effect to the company's corporate purpose. Ideally, that purpose ought to embrace long-term value creation thinking, targeting positive impact for the company's set of key stakeholders, including but not limited to shareholders and investors. So key aspects of what the board needs to really look at and challenge the management team on here is whether the company has included all material information that speaks to enterprise value and beyond as relevant to the stakeholder community. This is the double materiality concept, whether the board really needs to apply its mind on that fact. Has all the material information, ESG and financial information, gone to the market? Also, in relation to selection of appropriate standards and disclosure practices, this is a governance responsibility. It's not one that the board can abdicate to standard setters and say, well, we'll follow what the standard setters tell us to do. Rather, the governing body and boards need to look at those standards and say, these are the standards, but what do we need to achieve through our disclosure practices? And of course, that's ensuring that there's a selection of an external reporting suite that both caters to presentation of material information, but also ensures the connectivity of that information. The information cannot be publication of standalone reports that don't connect or don't speak to each other. And most particularly that information, the information contained in various statements, actually speaks to the financial statements and financial disclosures. On the quality of disclosures, these are all points that we're well familiar with. The board really needs to ensure that there's satisfactory application of measures to support the integrity of the information in those disclosures and the quality of the disclosures themselves, and also proactively assess financial reporting risks. This is the questions: are the controls that management has in place to secure quality and integrity of disclosures to the market sufficient to ensure that result? So those are all, just my summary of things that the board really needs to be attentive to. And I suppose the main point is that the fact that standards are available doesn't obviate the need for management and boards to pay, strict attention to the quality of the information they're putting into the markets and its relevance. So in this context, the use of the Value Reporting Foundation, or the IRC's integrated reporting framework, properly done, is an important enabler. An engaged application of the integrated reporting integrated thinking principles and the reporting framework will offset the likelihood that the reporter will follow the approach of merely complying with regulation and standards. And that's very important, as you said, Cyril. What you want to do is not end up doing more of the same, the compliance mindset. So the integrated reporting and thinking frameworks help with that enormously. They focus the corporate reporting management's attention on long-term value creation and sustainable business, speaking directly to all these ESG matters. So I suppose my point is that as we move into a new era of ESG standards, the important thing is to make sure that the result of implementation of those standards really counts. And the Value Reporting Foundation's integrated thinking principles are key in that regard. So these principles, of course, I'll just mention the 6 of them. They speak to purpose, strategy, risks and opportunities, culture, governance and performance. Now, anyone who's implemented the TSC framework can easily see that those 6 principles in the integrated thinking framework published in December 2021 are very closely aligned with the structure of the recommendations in the TCFD framework. Not only that, the TNFD framework, which is the Task Force for Nature-Based Financial Disclosures, will similarly adopt a similar, you might say, backbone or skeleton to set out the principles of the TNFD framework. That framework will be released in beta version in March, so just next month. So these frameworks are coalescing around these integrated thinking principles in a way that is actually magically quite wonderful. When integrated thinking was first put on the table some years ago, back in 2015, when this concept arrived, it seemed conceptual, theoretical. It seemed like something that one would, pay lip service to potentially, because it seemed quite sort of high up there and not implementable really. But this thinking has now become part of the frameworks and will guide reporters towards quality reporting outcomes if they consciously apply them. And this is a key thing. So what I'd encourage all the, sort of the persons on this call to do is have a look at this, specifically if you're in the conundrum of having unfortunately, a compliance-driven approach. The idea is to use these principles as enablers to move away from that and to get to a style of information disclosure to markets that really, really works. Obviously, it requires effort. As I said, it needs to be properly done. One can't claim to have done this if you haven't. And not only that, the benefits of doing your reporting this way also ensures that the management team and board will have a much better understanding of its business and its ESG factors as well. I'll stop there, Cyril. Thank you, and take any questions or hear the comments of the other panelists.
No, thanks for that, Joanne. And my experience of the Indian markets is that initially when a new regulation or policy comes, initially we kind of start off with a compliance mindset, but we also learn very quickly. A couple of years it takes, for the market to settle down, and then we move to a kind of a higher form. I've seen that across all sorts of regulations and policies that have come in India, because at the end of the day, the policymakers and the regulators take the lead, but it is ultimately the market that decides, and markets have a way of kind of rejecting BS and sort of getting to the substance of the issues. And I see no reason why that will not happen here. It's a very sophisticated market for disclosures and for and really it has now moved to an environment where you can't hide forever, and you can't fool them. You can't fool all of the people all of the time. Just to sort of bring in Shakespeare again. So I have hope in that, but it will be a bit of a slow beginning before it picks up momentum. I know we have very few minutes left before we wind up this panel. So I think it might be a good idea to take a few questions, and I'll request the SEBI or the NISM folks to throw up the questions.
Thank you, Mr. Shroff. So I'm here to. There were some questions which have come from the net, so let me focus on them. So let me combine some of the questions which are, which could address one another. Actually, one of the questions, I think it's addressed to Mr. Ajit Dayal, which is in the case of disclosure requirements, SEBI has moved on from BRR to BRSR, and in the process, it seemingly had ignored the E aspect, actually, which is the environment aspect. So that's from Ms. Prerna. That what's your view about it? That is it that she's quoting from a electricity utilization, energy efficient perspective.
So I think the E. I think there's no doubt that the E is extremely important. I don't think we should minimize it. And I think clearly, as Joanne mentioned, from an international perspective, the environmental factors are the most important when international investors look at any investment. So yeah, I think you're absolutely right. E is important, and it should be getting a lot more important than it does. I see there's one more question that I'll quickly ask about the retail investors, about where to get ESG. I think Indian retail investors so far haven't yet picked on to the ESG thesis. I think it'll happen over time, but it's not yet a hot topic in India as yet.
Which you had put it in simple that it is luxury of the rich, actually. So there's one more question, more from a green investors perspective on the green energy side. I think it's more to Mr. Mukundan about the policy constraints. Though there is an appetite to spend more on the green investment side, from the policy side, there are like certain concerns which actually prevents investments to flow in, actually. So, Mr. Mukundan, if you have to say that these are three policies which government, if it addresses, that could promote investments in green energy.
Actually, government has done quite a bit, I would say, and I think the kind of the whole transition pathway which has been laid out on solar, wind, and the hybrid model is, I think, very well understood. In fact, in terms of local manufacturing of these panels, the new PLI scheme, already you're seeing companies committing upwards of 5 gigawatts each of solar panel manufacturing locally in India. Wind, I think that has been addressed well. Where I mentioned we need to address at a policy level, and this needs political will, because this is the state electricity board, the distribution companies. Some states have moved. Unless we get to that, I think we are going to still have tariffs which are going to be, the system would be broken. So we need to get that. I think we have a central grid, but also at the electricity level, we need to also look at the quality of grid, which is at the various state and district level. Some states have done better job, others haven't. So this is something which the power ministry and the solutions exist for managing this transition. In terms of the overall policy, I think we still need to get our energy policy right. And that would then play into the whole tariff structure which we have for natural gas or carbon fuels and everything. I think that is something which is a larger picture which government needs to articulate. And I mentioned finally, while hydro will take its own time and we will have a continued exploitation of hydro, the other element which is let's say which will help us in the net zero carbon move is the nuclear piece, which we need to not, we should not shy away from working on it. New technologies like SMR have already come, which is the small modular reactors, which are being developed in US, especially by companies like NewScale or GE. And I think these technologies allow you to build power plants at 100, 200 megawatts and multiple power plants, which are very easy to maintain, but the liability issue needs to be addressed. So that's about the energy mix. There's a whole host of work to be done on the demand side. I think we've done a great job with respect to, encouraging the use of LED in lighting, but there's a whole host of work to be done in terms of how do you save energy in terms of the drives, in terms of various other energy guzzling units which we have across the industries, especially in the medium and small scale sector. So that needs to be addressed through some kind of a policy initiative which pushes companies to benefit from energy savings and access to capital to get those energy savings into the company. So I think that again is lastly, I think consumers, we've done a great job with this star rating, especially if you see air conditioning or refrigeration products. I think the star rating has really picked up with consumers. Consumers today would buy a more energy efficient product than less energy efficient and pay a premium because they know the total cost of ownership is going to be lower. So we have to address it at a central policy level. We have to address it at the specific industry level and also at the consumer level. All these three levels have to move. I think the big issue which we need to deal with is at the central policy level, which still needs to get addressed. Now, in terms of the overall ambition the country has set, companies which are listed don't have a choice, because even though country has set an ambition of 2070 as a transition to green, completely green, we don't have time till 2070. I can tell you most of us are working towards 2050. By 2030, we have already set targets. We're well on our way. And I think many of us are actually pushing hard to get ahead of the curve and move towards 2045, where we could declare ourselves as net zero. So while country has set 2070, I think companies, big companies, because we will lose access to capital in the international market if we wait beyond 2050. That is our fear. So we just have to move it so that we can still be an attractive set of organization. So all in all, I think a lot of work to do. The new green hydrogen policy in very early stage, again, very important pivot point for the country, because India will be, I think, what Middle East is to oil, India will be what Middle East to oil to the green hydrogen whole transition pathway. So a lot of opportunities, a lot of work to be done, but we have to look at it positively and keep pushing at the edges and also changing our whole approach to be more proactive than to be reactive.
Thank you, Mr. Mukundan. Before I close the session, one more question, if there is anyone from it, is I do not want to ignore anybody in the audience here. Is there any one question? Yeah, please.
Thank you for giving me a chance to ask a question. It is that to Ajit sir, who mentioned about the three innovation and stuff. I want to know what is their opinion on, as well the other answers. I wanted to know their opinion on how emission trading schemes in India, which have not been full-fledged, being implemented, is having an impact on the emission trading.
Mr. Dayal, if I can put this question straight. So she's more keen on hearing about, so we don't have a ETS, emission trading system in India. Would it have implications for our net zero ambitions?
Sorry, I didn't get the question. We don't have?
We don't have a full-fledged emission trading system in India. So will it be a hurdle for our net zero ambitions?
Ajit, I'll answer this.
Yeah, I'll let Mukundan go to
it. I actually, the carbon trading scheme is coming. The government has started consultations on that. So it will be a bit late, but it's starting. So while Europe is ahead of us, the energy trading scheme. There's a PAT scheme already, which is perform and trade, which is there for highly energy intensive industries like steel, cement. But the carbon credit scheme is being designed, and industry is in consultation with government. It will be announced very soon.
But if I can just add one comment, I mean, there's a lot of discussion whether carbon trading is actually a good thing or not, because really what it's doing is allowing some bad practices to go on and offset by someone else who's got a credit. So that's also a big discussion point within the ESG space.
I think also to mention though that the net zero pathway can be certainly can be nutted out with use of carbon offsets even in voluntary markets. So no, my response to the question would be no, it doesn't prevent it at all. You can do your net zero pathways, and there are very good publications on net zero pathways on the A4S website. I'll send links through to those to Cyril as well for anyone who'd like to look at them.
Thank you. Thank you. Before I put down my mic, let me thank Mr. Shroff for putting in the right and relevant questions to the panelists actually, and them coming up and highlighting the right sort of issues actually. If there is only one metric that I could depend upon to measure the success of the panel discussion, the number of questions that we have received on the online forum. There were too many. I couldn't get all of them onto you. But I would request them to mail it to me personally. I will be happy to address them, coordinating with you and everyone. Thank you, everyone. Thank you, Mr. Shroff, for your time. And thank you to Mr. Ajit Dayal, Ms. Joanne, Mr. Kehoe, and Mr. Mukundan for your time. Thank you very much.
A real pleasure.
Bye-bye.
Bye-bye.
Thank you.
Thank you.
Thank you, sir.
I think we will continue the next session from here on.